72 hours. That was the entire window. In just 3 trading days, what had looked like the strongest precious metals rally in modern history reversed into one of the most dramatic liquidation events markets have ever seen. Tuesday, Thursday, Friday. 3 sessions. 3 sharp moves. Trillions of dollars erased from market valuations. What happened on that Friday wasn't just a routine pullback or a normal correction, but even calling it a crash doesn't fully capture the sheer scale and speed of what unfolded. It was more like a controlled demolition, a rapid, coordinated unwinding of crowded positions that had been building for weeks, executed with remarkable precision. Imagine watching your portfolio, the one you'd carefully built, evaporate in an afternoon. That's what happened. Gold fell sharply, but silver was a different story. It didn't just fall, it plummeted, losing a huge percentage of its value in a matter of hours. The strange part? No sudden geopolitical shock, no unexpected natural disaster, no major bank failure announced that morning. The news was quiet. Yet, prices were collapsing while liquidity, the ability to buy or sell, simply vanished. It was like trying to run through quicksand. Now, let's add another layer. The broader political backdrop was already tense. In Washington, lawmakers were playing a high-stakes game, edging closer to a potential government shutdown. Uncertainty wasn't just in the air, it was a thick fog. And into that tense environment came one of the most violent single-day sell-offs the precious metals market has ever recorded. Many of you watching this probably lived through it in real time. Maybe you were holding physical gold or silver, thinking it was your safe haven. Or perhaps you had exposure through ETFs or even leveraged instruments, hoping to capitalize on the rally. Gains that had taken months, even years, to build were wiped out before the closing bell. In the aftermath, the explanations started rolling in. You heard the familiar refrains. Markets had overheated, sentiment had become too bullish, prices just needed a reset. And while those explanations aren't entirely wrong, they are dangerously incomplete. They paint a picture of a random, chaotic event. But what if it wasn't random at all? This move, this catastrophic drop, didn't just begin on that Friday. The seeds were planted days earlier, quietly, almost invisibly. To truly understand what happened, we need to rewind the clock. Let's go back to Tuesday, January 27th, 2026. The U.S. president delivers what most people watching considered a routine policy statement. It was dry, filled with political jargon, and easy to tune out. But buried deep inside that speech, almost a throwaway line, was a comment that mattered deeply to a very specific group of people: currency and commodities traders. The president made a subtle suggestion, a hint that a weaker U.S. dollar could be beneficial, that it could help American businesses compete on the global stage. For the average person, this comment meant nothing. It flew right under the radar. But for those who operate in the world of high finance, it was a coded message. A weaker dollar often means higher prices for commodities like gold and silver, which are priced in dollars. This should have been bullish, right? It should have sent precious metals soaring even higher. But instead, it marked the beginning of the end. It was the first move in a 3-day chess game that would culminate in a market massacre. That single sentence, overlooked by millions, was the trigger. It set the stage for the massive, coordinated unwind that was to come. It was the signal that the big players had been waiting for, the starting gun for a race to the exits. And by the time most retail investors realized the race had even started, it was already over. The initial reaction to the president's comment was, paradoxically, a surge in precious metals. It seemed to confirm the narrative. The dollar was going down and gold was going to the moon. By Wednesday, the market was euphoric. Gold pushed past key resistance levels and silver looked unstoppable. Online forums were buzzing with talk of new all-time highs. Mainstream financial news channels ran segments with analysts predicting the rally had much further to run. Everyone, it seemed, was on the same side of the trade. They were all long gold, all long silver. And that's exactly where the danger lay. When everyone is on one side of a boat, it only takes a small push to capsize it. The market had become incredibly crowded, a tinderbox waiting for a spark. That spark came on Thursday. It wasn't a huge fire, just a flicker. A large institutional sell order hit the market during a typically quiet period. It was big enough to cause a dip, but not so big as to cause a panic. The price of gold and silver wobbled, then recovered a bit. Most people dismissed it. They saw it as profit-taking, a healthy sign. A small pullback before the next leg up, they told themselves. But it wasn't a pullback. It was a test. The big players were probing the market's defenses, checking for liquidity, seeing how the market would react to selling pressure. They were gathering information, preparing for the main event. What they found was that beneath the surface of bullish enthusiasm, the foundation was weak. There were very few large buyers willing to step in and absorb significant selling. And that brings us to Friday morning. The trap was set. The market was primed. The coordinated unwind began not with a bang, but with a whisper. A cascade of sell orders, executed through sophisticated algorithms, hit the futures market simultaneously. These weren't just simple market sells, they were strategically placed to trigger stop-loss orders from smaller traders. Think of it like a chain of dominoes. The first sell order knocks over a few stop losses, which creates more selling, which in turn triggers even more stop losses further down. It's a feedback loop, a self-perpetuating cycle of selling that feeds on itself. The price starts to slide, slowly at first, then picking up speed. Panic begins to set in. The liquidity that was tested on Thursday completely evaporated. The speed was breathtaking. This wasn't a gradual decline over weeks or months. This was a vertical drop in a matter of hours. The algorithms didn't care about fundamentals or long-term value. They were programmed to execute with ruthless efficiency, exploiting the panic they themselves were creating. For anyone trying to trade this manually, it was impossible. By the time you could react to a price move, the market was already 10 steps ahead of you. It was a financial blitzkrieg. So who was behind this? The narrative of an anonymous, faceless market is comforting, but it's not the whole truth. This kind of coordinated action requires immense capital and sophisticated infrastructure. We're talking about large hedge funds, algorithmic trading firms, and the proprietary trading desks of major banks. These are the whales of the financial ocean. They saw the overcrowded trade, they understood the underlying fragility, and they timed their exit perfectly. They didn't just sell their positions. They likely went short, betting on the price to fall, profiting immensely from the very collapse they helped engineer. Was it illegal? That's the million-dollar question. Proving market manipulation is notoriously difficult. The line between aggressive trading and illegal manipulation is often blurry. The players involved would argue they were simply managing their risk, that they saw an overvalued market and acted accordingly. They were just smarter and faster than everyone else. And in the eyes of the regulators, that's often good enough. There's no smoking gun, no leaked email saying, let's crash the market on Friday. There's just a pattern of trading that, when viewed in hindsight, looks devastatingly effective. The aftermath left a trail of financial wreckage. The stories were heartbreaking. People's retirement savings, college funds, the nest eggs they had painstakingly built over decades, all decimated in a single afternoon. The explanations that they were greedy, that they should have known better, ring hollow. They were caught in the crossfire of a battle between giants, a battle they didn't even know was being fought. The market isn't a level playing field. It's a complex ecosystem where predators and prey coexist, and on that Friday, the predators had a feast. This event serves as a brutal reminder. When an investment becomes the consensus trade, when everyone from your taxi driver to your dentist is talking about it, that's often the time to be most cautious. The financial markets have a long history of punishing the crowd. The lesson here isn't to avoid precious metals or to never trust a rally. The lesson is to understand the game being played. It's to recognize that behind the charts and the headlines, there are powerful forces at play with their own agendas. It's to remember that in the world of high-stakes finance, 72 hours can be an eternity, and the line between wealth and ruin is thinner than you could ever imagine. What happened in those 3 days wasn't just a market event. It was a masterclass in financial warfare. And for those who paid the price, it was a lesson they will never forget. Thank you so much for watching. If you found this breakdown insightful, please hit that like button. And to a casual observer, it just sounded like some abstract economic theory. But for trading professionals all over the world, it was a clear signal. A weaker dollar has historically supported higher prices for commodities priced in dollars, like gold and silver. Within just hours, positioning shifted. Funds started reducing their dollar exposure, and capital began flowing into precious metals. The momentum built up, and by Thursday, prices had reached levels few thought possible. Gold and silver hit historic highs. The sentiment became euphoric. Social media was flooded with optimistic forecasts. Retail investment surged and leverage increased. The trade became incredibly crowded. And then Friday morning arrived. Before the U.S. markets even opened, news broke that the president had announced a nominee for the next Federal Reserve chair. This individual was widely seen as favoring tighter monetary policy and a stronger currency. That single announcement completely flipped the narrative. Traders who had positioned themselves for a weaker dollar were suddenly facing the exact opposite outlook. Positions that made sense on Tuesday were disastrous by Friday. The reversal forced rapid adjustments. Dollar shorts were covered. Metals positions were reduced. The selling fed on itself. But even with all that, the scale of the decline surprised almost everyone. Silver's drop went far beyond what most models would predict from a policy signal alone. Part of the reason for this was structural. The precious metals market relies heavily on leverage and derivatives. When prices fall quickly, margin calls accelerate the selling. At the same time, buyers who would normally provide support might step back. On that Friday, liquidity thinned out dramatically. Data from Asian markets showed heavy futures trading activity, but very little movement of physical metal. This distinction is crucial. Futures markets can move vast quantities of paper metal without requiring actual delivery. When many participants rush to exit at once, prices can gap lower even if long-term physical demand remains strong. The result was a sharp disconnect. Screen prices in Western markets plunged, while physical premiums in parts of Asia remained elevated. In some regions, real metal continued to trade at much higher levels than futures prices suggested. That gap highlighted the difference between short-term financial positioning and longer-term physical demand. Timing also played a role. The sell-off happened at the end of the month, a period when funds rebalance, banks manage their balance sheets, and margin requirements matter more than usual. In the weeks leading up to the decline, exchanges had raised margin requirements multiple times. Each increase meant traders needed more cash to hold the same positions. When prices turned, those higher requirements amplified the forced selling. This pattern isn't new. History shows similar dynamics during previous silver peaks in 1980 and 2011. In both cases, rapid price gains were followed by margin changes, liquidity stress, and sharp declines. The details differ, but the structure is familiar. What often gets overlooked is what happens after all the volatility. While leveraged traders are forced out, long-term buyers with strong balance sheets step in. Central banks in particular have continued accumulating gold over recent years at one of the fastest paces in decades. At the same time, the dollar's share of global reserves has gradually declined. That contrast is striking. During moments when paper prices fall the hardest, physical accumulation often continues quietly in the background. It suggests that short-term price action doesn't always reflect long-term confidence. For individual investors, this creates a difficult emotional challenge. Sharp drawdowns trigger fear. The instinct is to sell simply to stop the pain. But history shows that the worst moments psychologically are often near important turning points. This isn't advice to buy or sell anything. Markets carry real risk, and leverage magnifies it. But understanding how these moves happen is what matters. Extreme volatility rarely comes from a single cause. It's usually the result of positioning, leverage, policy signals, timing, and liquidity all colliding at once. If precious metals truly had no role in the modern financial system, they wouldn't provoke such intense reactions. The fact that they do suggests they still matter as indicators of confidence, currency stability, and systemic stress. Paper prices can move fast. Physical assets move more slowly, but they don't disappear when screens turn red. That distinction is why these markets behave the way they do during periods of stress. 72 hours were enough to expose just how fragile crowded trades can be. The setup took weeks, the unwind took hours. Those who understand that cycle are better prepared for the next time sentiment reaches an extreme. What you do with that understanding is your choice. But remember this episode. Remember how quickly conditions changed. And remember that markets don't move on emotion alone. They move on structure, incentives, and timing. That perspective is what this channel is all about. Looking past the headlines and focusing on how the system actually behaves when pressure builds. If this breakdown helped you make sense of what happened, share it with someone who struggled to understand the move. Information doesn't remove risk, but it does reduce confusion. And in volatile markets, clarity matters more than ever. What matters now is what comes next, because moments like this don't end the story, they reset it. After events like these, markets don't immediately return to calm. They pause, reassess, and slowly reveal who was trading momentum and who was positioning for the long term. In the days following the sell-off, volatility stayed elevated. Confidence didn't return overnight, and how little warning there seemed to be. That hesitation itself became part of the story. When fewer traders are willing to take risks, price discovery slows, and the market becomes more sensitive to every new headline, every policy hint, every data release. Behind the scenes, though, something quieter was happening. Physical demand didn't vanish. In some regions, it even strengthened. Premiums stayed firm even as futures prices struggled to stabilize. That divergence wasn't dramatic enough to dominate headlines, but it was steady, persistent, and telling. This is often how turning points form, not with loud announcements or immediate rebounds, but with subtle shifts beneath the surface. Leverage gets flushed out. Weak hands exit. Positions move from traders who needed perfect conditions to holders who can tolerate uncertainty. The market stops reacting to panic and starts responding to fundamentals again. History shows that after extreme liquidations, the next phase is rarely straight up or straight down. It's uneven. Sharp rallies are followed by pullbacks. Optimism clashes with lingering fear. Analysts argue. Forecasts diverge. That confusion is not a flaw. It's part of the healing process. It's the market finding its footing, shaking off the speculative excess, and rebuilding a foundation based on real value, not just momentum. And that's where the opportunity for understanding truly lies. By observing what happens in these quiet, confusing periods, we can get a much clearer picture of where the real strength in a market is. It's a lesson that applies far beyond precious metals. It's about looking for the signal in the noise. Thanks for watching. What separates those who survive these wild market cycles from those who don't? It's not prediction, it's preparation. It's understanding how leverage works, knowing that margin rules can change without any notice, recognizing that policy signals can be confusing, and that markets often move the hardest when different stories collide. This past week was a powerful reminder that modern markets are not just about simple supply and demand. They are about structure. It's about who has to act right now and who has the luxury to wait, who is being forced to sell and who is free to buy. In the short term, prices don't always reflect value. They reflect pressure. The people who struggle the most in these moments are usually the ones who believed the ride would be smooth, that volatility was a thing of the past, that prices only go in one direction. Markets punish that belief relentlessly. They always have. And yet, every time this happens, the same lesson quietly repeats itself. The assets that survive these violent sell-offs tend to do so because something real is supporting them. Real demand, real utility, scarcity, or trust that's been built over a long time. When all the speculation burns off, what's left is much closer to the truth. So whether prices recover quickly or slowly isn't the real question. The real question is whether we, the participants, adapt. Will we stop assuming that stability is guaranteed? Will we learn to separate the market noise from the actual signals? Will we finally understand that risk doesn't just disappear because a trade feels popular? What happened over those 72 hours wasn't just about metals. It was about how our modern financial systems behave under stress, how quickly sentiment can flip, how policy, leverage, and timing can align to create moves that feel shocking, but in hindsight, were structurally predictable. These moments are uncomfortable, but they're also incredibly revealing. They show you where liquidity really comes from. They show you who actually controls the rules of the game. They show you which prices are driven by pure urgency and which are supported by genuine conviction. If you watched this all unfold and felt confused, frustrated, or completely blindsided, you were not alone. That reaction is exactly what fast-moving markets are designed to produce. The goal now isn't to relive the panic, it's to understand it. Because this one might be the last time volatility squeezes weeks of movement into just a few hours. It won't be the last time a crowded trade unwinds violently, and it won't be the last time people are told afterward that it was obvious all along. The next time conditions line up like this, stretched positions, heavy leverage, policy uncertainty, and thin liquidity, you'll recognize the pattern. And recognition, more than prediction, is what keeps you grounded when markets move the fastest. That awareness is the real takeaway. Not fear, not certainty, but understanding. From here, the takeaway goes even deeper. Markets aren't just numbers on a screen. They're a reflection of human incentives, psychology, and structure. Every single move, no matter how random or extreme it seems, has a reason behind it. Even the sharpest sell-offs are rarely accidental. They are the result of overlapping pressures, timing, and the way we all react to one another. When leveraged positions unwind quickly, when margin calls cascade, when liquidity dries up, prices can overshoot. That overshoot is where emotion meets structure. Fear accelerates selling. Hesitation slows the recovery. And in that gap between panic and understanding, opportunities emerge for those who are prepared, patient, and informed. One of the most important lessons is learning to distinguish between short-term fluctuations and long-term trends. Prices can swing violently in a matter of hours, but the fundamentals, like supply, demand, and utility, don't change that fast. Gold and silver, for example, have intrinsic roles. They store value, hedge against currency risk, and serve as tangible assets outside of purely digital systems. A temporary price drop on paper doesn't erase that reality. It's also crucial to notice how global dynamics influence local markets. Actions in one region, like changes in margins or new regulations, can ripple across continents. Meanwhile, physical supply and demand continue on quietly, often disconnected from the frenzy on our screens. Recognizing this gap helps you distinguish noise from meaningful signals. Cycles of fear and greed are unavoidable, but the lessons from past market events are always relevant. Those who panic sell during sharp declines often regret it, while those who stay disciplined and informed tend to benefit when the dust finally settles. History doesn't repeat itself exactly, but it certainly rhymes. Patterns in volatility, leverage, and liquidity always come back, and understanding them gives you perspective, even in the most chaotic moments. Ultimately, the goal is to approach markets with awareness, not emotion. Recognize the triggers, understand the mechanics, and be conscious of the timing. Temporary losses do not define your long-term outcomes. Paper prices can fluctuate wildly, but physical fundamentals, long-term demand, and structural integrity endure. When you step back and analyze events like these, you see that volatility is not just risk. It's information. It reveals the pressure points, the weak spots, and the forces shaping market behavior. Those who pay attention gain insight, and those who understand are better equipped to navigate what comes next. The markets will move again. Positions will shift. And when they do, understanding how these mechanisms work will make all the difference between reacting blindly and making measured decisions. In the end, knowledge is the tool that allows you to remain composed, recognize opportunities, and avoid being swept away by temporary panic. The recent events weren't just a lesson in losses, they were a masterclass in structure, timing, and awareness. Every one of us can take something valuable away from that. Whether you trade actively or hold for the long term, the principles are the same. Watch how the system behaves under pressure, distinguish between paper and reality, recognize the cyclical patterns, and remain grounded when volatility strikes. Those insights are the real prize. Thanks for watching, and don't forget to subscribe for more content to help you navigate these markets.